Maybe let's mute, and I see there's already a couple people in, and give a few. Everyone, welcome. We'll give another minute or two to let a couple more people join. I can see a whole lot of people are joining, but I think let's give it another minute and then we'll kick off. Okay, let's jump in and get started. Thank you for joining today. Lots going on in the Canadian regulatory space, and happy to have everyone here today. I guess let's kick off with a couple introductions. I'm Adam Katz, the founder and CEO of Cultra. Cultra provides back office, middle office, front office compliance solutions to firms offering foreign exchange to their customers. We've been involved in derivative trade reporting in Canada, Australia, and Europe since 2014. And we're very pleased to have with us today Noah and Tara, who are both experts on derivative trade reporting with big changes just around the corner in Canada. Tara, would you like to introduce yourself?
Hey, yes, thank you, Adam. So I'm the Chief Compliance Officer at CORE. For those not familiar with CORE, a little background, we were founded in 2021 by a group of former trade repository executives who saw the need for something better in the space, something more responsive to our clients and the evolving regulatory landscape. CORE is a registered trade repository in multiple jurisdictions around the globe, and we also offer regulatory reporting services that support submissions not only to RTR but to others as well. Our goal is really to help clients navigate their reporting obligations and operational controls. As for me, prior to CORE, I spent over 15 years at ICE, where I was deeply involved in building out the trade repository infrastructure from the earliest days, going back to when the Dodd-Frank rules were first proposed. So I've had the opportunity to work closely with regulators globally throughout the evolution of the regimes and see how the complexity and everything's evolved with trade reporting around the globe. Noah?
Thanks, Tara. My name's Noah. I'm with Renault and Co. I'm a partner and I lead the regulatory team. We're a law firm. We started out as a crypto-specific law firm, but have evolved into general financial services regulatory law firm. We help financial services firms navigate complex regulatory landscapes, and we help them meet their compliance obligations efficiently and effectively. And I'm excited to talk about derivatives reporting today.
Thanks so much, guys. Great to have you both here. Let's dive right in. I want to take a step back and just talk about the background behind derivative trade reporting. Maybe Tara, you can kick us off and give us some background. You were here, I think, from the beginning. It'd be great to get your perspective.
Happy to. So, derivatives trade reporting has come a long way since the introduction of Dodd-Frank, which was really the first major implementation of obligations, and it went live in 2012. Since then, we've seen a global expansion of trade reporting regimes with jurisdictions across the G20 adopting their own frameworks, each with similar objectives, but they often differ in their implementation methods. So, over time, regulators have had the opportunity to analyze the data they've been receiving. It's become clear that while the transparency has improved, the data quality still remains a significant challenge to them. As a result, many jurisdictions have initiated rewrite programs or rule amendments aimed at cleaning up and standardizing the data. We're now seeing the final stages of fundamental global elements such as UTIs and UPIs, and for some jurisdictions, ISO messaging being rolled out. So these standards are intended to drive consistency and comparability across jurisdictions, and the focus has shifted from simply collecting the data to ensuring that it's accurate and complete and usable for these regulators.
Very interesting. It sounds like quality is really the name of the game, and I know that came up a lot in our three previous discussions. Noah, maybe you can talk from your side a little bit about the reporting from a Canadian perspective. We've been reporting for a little over 10 years now, and I'd love to get your perspective of how you've seen things play out.
Sure. Yeah, I might go back to first principles here, right? I mean, Canada, I think, is such a unique financial services environment, right? We've got a wonderful banking system, really, as you know, the cliche is that it's the envy of the world. It's certainly a stable environment, but nevertheless, even before the 2008 financial crisis, we had the asset-backed commercial paper crisis, where those products, that market essentially froze up, and really the problem was that instead of good quality liquid trade receivables and things like that. We had layers of synthetic derivatives, and nobody really understood, what was going on. And when we had a problem, I think regulators very quickly realized that without that data, it's very difficult to remedy the problem. And then, of course, 2008 was just drove that home. 2008, 2009. And I think, as Canadians, we sort of can often lose track of how bad things got. But I pulled some data about spreads and bond spreads and credit default swap implied default rates, and I mean even um, our highest quality issuers were trading at near junk levels, and there's one, I won't name their name, but there's one really good quality life insurer. They have some of my life insurance, really AAA stalwart company, and the credit default swaps were implying, 40-45% chance of a default. So, that's bad. And I think regulators quite rightly in Canada, as they did everywhere all around the world, recognized that we needed quality data. And so what we've seen in the last sort of 10 years or so has been an ability for regulators to get a real line of sight in Canada as they have everywhere else. But of course, we have our quirks, we have our single-sided reporting, and then of course we have the fact that and this problem has largely been solved, but earlier on in the process, the fact that we have this real patchwork of regulation is maybe that's not nice enough, but let's just say we have differences in regulation across various jurisdictions in Canada that created some challenges. So that's largely been resolved now. There are still some differences, but I would say in effect things have been standardized. But I sort of think of the last 10 years as the beta test, and now we're in production, right? So now it's real, and I think we'll start to see the effects of that in the coming years.
A long beta test. Great. I'd like to jump to the topic of really who has an obligation to report, kind of stepping into these requirements. So trying to keep on the topic really of foreign exchange derivatives here. Let's talk about who has an obligation to report, kind of how does delegated reporting work in Canada, and also who might not realize that they are trading in foreign exchange derivatives and they actually do have an obligation to report. So first, Tara, let's kick it off with you. I'm interested to know from the regulator's perspective, what are they really looking to accomplish? It sounds like the real goal here is market transparency. Whose activity are they really interested in? Where are they really diving in?
Yeah, so from the regulator's perspective, the objective isn't just checking the boxes of the regs, it's to gain visibility into the real risk in the market. They're focused on understanding who's taking the risk on, where the risk resides, and how it's moving through the financial system. That includes activity in both the Canadian entities and foreign dealers engaging with Canadian clients. Ultimately, it's all about market transparency. So regulators want to understand the systematic exposures. They're not just focused on the large banks or frequent traders. They care about anyone who's participating in the derivatives market in a meaningful way. Less frequent end users whose activity may still have risk or liquidity implications still get involved in trade reporting. In Canada, reporting obligations are determined on a product plus a local counterparty basis. But it's important to note that Canada doesn't follow the delegated model in the same way that you see in Europe, where both counterparties may independently have reporting obligations. So Canadian regulators expect to see single-sided at the end of the day, even though the regs could possibly allow for dual-sided, they really do want to see a single-sided reporting regime. This makes it especially important for entities to understand both their own regulatory status and that of their counterparty. For example, whether your counterparty is a derivatives dealer or a local counterparty for a particular province may affect your transaction is reportable and where it must be reported. Because of Canada's multi-jurisdictional structure, that means simply submitting a trade to a Canadian trade repository is insufficient. So the trade must be correctly reported to each province where the reporting obligation exists. This often means reporting to multiple Canadian jurisdictions for a single transaction. In practice, it means Canadian firms, even foreign firms transacting with Canadian entities, need to perform fairly complex counterparty classification exercises. to determine which provinces are in scope. Most firms will rely on the Canadian ISDA representation letter for this, and that is helpful in many ways.
All right, in the absence of the ISDA representation letter, could two firms who are trading bilaterally still kind of agree who should be the reporter?
Yeah, they definitely can do that. I mean, I think what's important is that they're communicating one, where are they local counterparties, because it may not just be one province, it could be multiple provinces. So making sure that information is communicated is super important, as well as determining who is going to be the reporter and the UTI creator.
That makes sense. Thank you. Noah, how have you seen this apply in Canada? Outside of the firms who are explicitly trading in derivatives, do you have customers? I'm sure you've seen a few things in your day where companies who didn't realize they had a reporting obligation actually did.
Yeah, there's been more than one occasion where I've made myself less popular by saying, "Hey, I think you're engaging in derivatives related activities." Um, there are a few, I made some notes in advance thinking about this, that there's a few sectors that really sort of pop out. I mean, we have a tremendous number of small money service businesses in Canada. Now that may change. There's some new legislation that I think is going to affect them. The RPAA will affect many of them, and the obligations under that. But that's a separate topic. And for now, there exists plenty of them, and many of them will sort of. There's like a complete lack of knowledge in this area, right? They don't understand that anything that any FX trade that doesn't settle in 2 days is effectively a derivative, right? They're getting into informal forwards with other MSBs, with clients, things like that. Accidentally offering credit or margin, right, which sort of brings them into zero registration territory, and really just having no real understanding of who the reporting counterparty might be. You know, it's often the larger counterparty based on notional volume. Like, does either one know? Do both know? Like, does neither? So we see a lot of stuff around that, and there's a lot of education going on. Another place can be corporate treasuries. Where they, depending on where they fall in the reporting hierarchy, they may or may not be aware of their obligations. Canadian subsidiaries of foreign entities that might be small, might not really understand what their obligations are. Entities acting as guarantors for affiliates, that can trigger an obligation. Non-exempted intra-group trades, right? All kinds of things like that. And there's sort of a lot of technical knowledge that needs to go into it. An interesting one that we've seen is operating companies, like maybe companies with long-term agreements, like software service agreements, things like that, where there's actually like an embedded derivative in a service agreement, right? Nobody even realizes that it's actually an FX derivative. One that I'm almost reluctant to even mention, but like crypto, right? I don't even want to get into it because there's like just a massive, so many issues and considerations around that. But anyway, a lot of these industries are places where we see it. And I think sort of three key takeaways, right? Like, have a derivatives use policy, right? Like, create the policy, make sure that it makes sense for your organization. Train your staff, right? And no, they don't need to be experts. They need to know when to go to the experts, right? Internal or external. They need to have that issue spotting ability. That's really helpful. And then really just understanding roles and responsibilities, like who has to report. Is there a designation in an agreement, or does it default, to the rules? Things like that will really go a long way towards addressing this.
Very interesting. Yeah, it's really tough if you're a small firm and you don't have the resources to keep up with these rules, to keep up, especially when they're changing all the time. I mean, this one's been a while since the change, but I get a sense from Terra that we'll see more changes, more frequent changes come in the future, and that makes it really hard for smaller firms to keep up. I'd love to dive into some of the big changes that are coming. Tara, we'll start with you again. Can you enlighten us on some of the major changes? I'm thinking about things like the critical data elements and UPIs and UTI harmonization. What do Canadian compliance officers need to know?
So this is something I could go on and on about, but sort of hitting the big topics. So First is the UTI alignment. So Canada is adopting the global harmonized UTI format, which has really already been in place under regimes like CTC for some time. However, even today, many firms still struggle with full alignment with it. It might be that an upstream system or an execution venue hasn't upgraded and they're using an incorrect UTI format, or someone outside of North America is giving them a UTI that wouldn't be valid today. But really, even with that, the biggest challenge is not the format itself, but it's the UTI communication. Many firms assume that if they're not the UTI generator, it's really not their concern, but it is critical to obtain that UTI record from your counterparty, usually via the confirmation. For North American firms, the good news is that typically you fall under the UTI creator role if you are the reporter. But if you don't, you still need to make sure that you're not just simplifying your workflows and throwing in a dummy UTI just to simplify reporting when you're not that creator. You really need to hold that report and get the UTI from your counterparty before reporting, because it's important that that UTI is used consistently across all global jurisdictions for that same trade. So next, going on to UPI. So Canada is introducing the unique product identifier across all asset classes except commodities, which aligns with the CFTC, where other global jurisdictions have adopted commodities as well. Sort of North America has held off on that a bit because it does have more issues than the other asset classes. And while the UPI is a powerful tool in theory, the current ecosystem still presents some major hurdles. Adding new product types is a slow and opaque process, leaving market participants to sometimes use illy formatted UPIs. Sort of complicating that is which manages the UPI registry. They're not really subject matter experts in anything. They sort of use committees to go through things, so it's a slow process. And then what you'll see is there's a lot of data issues, like you'll see duplicate reference rates or overlapping product structures. So what we run into a lot of times is two counterparties trading the same trade, meaning to report the same thing, and they report two different UPIs. But when you actually look at the underlying UPI structure, they really do mean the same thing, because there's just not really clear guidance on that. But hopefully, over time, as it's globally adopted, we'll come to see it further expanded and refined, and because it really does have a good potential to be an invaluable tool to help with validations and data quality. And lastly, the CDE alignment. So Canada has adopted many of the CDE or common data element fields. Initially, they were going to align with the CFTC tech spec update, but since that CFTC update was delayed, Canada has really now jumped ahead on a number of fields, which isn't common. Typically, they sort of follow the CFTC in this area. But, until the CFTC does eventually get that up, we're going to be a little bit of misalignment. And while the CD is intended to support global harmonization in practice, many of the fields are really just defined in name only. What the CD has not done is given clear reporting logic or validation standards. And this creates a burden for reporting firms who must interpret and implement the same field differently across jurisdictions, because regulators will put different validations per their jurisdiction, which then it's very costly, because you'll see two firms, that same field now has to be reported completely differently just because that hasn't been standardized. I think one example would be for FX would be the put and call amounts for digital options. And APAC regions, they've clearly carved those out that put and call would not apply. But in North America, they have not. So you either can sort of put the notional amounts in that field, or you can put the all in nines, not applicable value. You sort of have to make a decision of what to do, because it's not clear, because the validations haven't really caught up. So in summary, while the rewrite brings Canada much closer to the international alignment, compliance officers should not assume that global harmonization means reduced complexity. In many cases, the alignment is structural, but the implementation can still be jurisdiction specific.
A lot of complexity between trying to figure out if you need a report in the first place, like we're discussing before, and now trying to figure out how you should report, and then trying to meet all this. It's a very complex process. No, on your side, from an implementation perspective, can you discuss some of the challenges you're seeing your customers face I've heard from a bunch of our customers that getting the UPI is very difficult. The UPI communication that Tara was referring to, especially if it was booked in the trade was booked from another jurisdiction. If the LP resides somewhere else and you still need that UTI, and what do you do? Yeah, I'd love to hear some of the issues you've been coming across.
Yeah, I mean, there are issues on timing. There are issues in there's still some issues and differences in standards, and there's issues in um, just communication and in general. Um, at the end of the day, in a perfect world, you'd have a single UTI that would be generated for a trade and used consistently across all relevant jurisdictions. That would be nice, but unfortunately, that's not the reality. Um, you know, we've got in Canada the reporting counterparty hierarchy. There's no standardized, at least as far as I'm aware, no standardized cross-jurisdictional protocol that really makes everything perfect. So there's a lot of mismatches and things like that. And then, the issue, I guess, is what do you do when there isn't a problem, right? Because at the end of the day, you have a requirement to file this stuff. And if you're not getting it, I mean, the we didn't get it from the counterparty isn't an excuse for not having it, right? Like you've got to have a solution. And at the end of the day, I think, Canadian entities will, Canadian dealers in particular, but any reporting entity will be required to show the regulator that they have a process for managing things when they go off track. So we're recommending that our clients handle that the way they do sort of any compliance issue, which is to really document the remedial measures that are taken and the efforts that are taken, even down to the level of, saving the email, right? Save the messaging, save the communication with the counterparty, right? Show that you put in the effort to, to try to get this, to get the UTI. Where we're seeing, different formats, right? Because that's another thing I know that Tara's sort of addressed that at least in part, but or efforts to resolve that. But store the foreign UTI in the other UTI field and have a CSA compliant version in the UTI field, and then sort of ensure that you have your logic mapping for when you are inspected and things like that. I think both of your organizations can be super helpful there, probably a lot more than I could, right? I'm the guy who gets called when there is a problem, but um, there's a lot of internal logic that needs to be adhered to that is fairly sophisticated, fairly complex, as you alluded to, Adam. And it's just essential that people get it right. And whenever you have a system like this where there's a lot of complexity, inevitably you have errors, right? So quality control, um, having an internal process to do that quality control, catch issues before they become systematic, so you don't get into an enforcement situation. That's really key from a compliance perspective.
This is actually one area where I'd love to see regulators put a little pressure on the larger LPs, the guys generating the UTIs, to make this really accessible to clients. I mean, unfortunately, in our experience, they're never provided on the confirmation. And what we always get told is the trade goes from the front office system to a back office system to a compliance system, and the UTI is created at some point, but it doesn't speak back to the front office, and then clients are just waiting and don't have it.
You know
And
what,
it
Adam?
seems
That's
like
such a good idea. Just put it on, like if it could just be on the con, like what a great idea that would be.
yeah, I mean, I think I think we saw it with the travel rule when the travel rule came into effect, and banks weren't giving the MSBs the data they needed to meet the travel rule, and you end up in this difficult spot where it's impossible to comply, except unless you're checking each report manually and asking them for the UTI. Um, I I want to jump on, another area of complexity within FX is structured products. I know, Terry, you've touched on this, and we've been chatting about this for a while. TOFS is really interesting because we've seen over the years most market participants reporting a synthetic derivative effectively, reporting synthetic legs, racking up trade reporting costs. not really reflecting what the client has traded. It sounds like there's some movements, there's some push to fix this, get a UPI out, have a proper way to report TOFs. I'd love for you to share with everyone.
Yeah, so this definitely has been a discussion topic. I mean, there's some working groups in the industry, as well as even several regulators have sort of gotten together to discuss this topic as well. Um, sort of one of the big pushes that causes a lot of this issue is that there's not a UPI structure for this. Um, so like you said, many of firms are sort of decomposing these into multiple legs and then reporting them as packages, which in some cases, it makes sense that FX has to be reported in packages, but in this case, it doesn't necessarily. It could be done other ways. I think that would be more efficient for firms financially and just reporting wise. Even though there is promising movement, like for example, has acknowledged this um, and that it is a priority of working through solutions. However, is often the case, UPI is slow. Getting regulators working together to come to agreement is also slow. Hopefully, we will see some progress on this, but at this point, we don't really have any type of deadlines. I think the second piece is even though when we do get the UPI available, I think we could look at reporting these as a single trade and leverage the schedule of fields to reflect the payment structure. But that sort of brings a second limitation in the market, which is the TR infrastructure. So not all trade repositories are currently equipped to handle extensive schedule data. For instance, with when we built Core, we had the foresight and we really have unlimited schedule fields. We expect that these could be very large for trades, whether it's FX, commodities, whatever. That these can be pretty large trades. But other TRs that have been around, such as DTCC, have very hard limits on their field submission. And really, what this does is it forces reporting entities to split their submission and almost create artificial lifecycle events to fully represent the trade. This adds a lot of complexity and mismatching and system development that really just shouldn't be necessary if the regulators were to require TRs to support full schedule of fields. Um, so almost until that happens, it may be easier to just be reporting them as legs if you have to be reporting in batches of schedules.
That makes sense. Yeah, and when we were discussing, it was April when they were targeting to get the UPIs out with implementation in November, October, November. It sounds like for July 25, we're in the same boat. We're reporting as synthetic legs and all these structures, or as packages.
Mm-hmm. Yeah.
That's good because I've told a lot of people UPIs are coming for TOFs, and now everyone who's listening can know they're not here yet. One of the other changes that on the surface looks like it's actually helpful is that given all of this additional complexity, you need to get the UTIs, the UPIs, etc. The timing of getting reports in it seems to have been loosened a little to now report no later than T+1 from the previous 15-minute requirement. Noah, can you share some insights into these changes? Why has this all been relaxed?
Sure, sure. Well, I mean, it's interesting, because it's a big difference, right? 15-minute reporting versus T+1. But, some parts of it are being relaxed, but other parts aren't, right? And I think I would caution uh, market participants from thinking that, this is now um, a relaxation of this. It's a relaxation of certain standards, but it's a reemphasis on others, right? So it's a trade-off that's going on. So sure, there's less pressure for immediate real-time submission, but there's more pressure to add more information and to get it right. And I think I know that the regulators were explicit. The CSA last summer, when they in their news release, they said we want higher quality, more consistent data, right? There were too many errors. I think originally there was a sense that there needed to be real time monitoring, and I think with the passage of time, there's a recognition that T+1 should be adequate in most circumstances, and so the trade-off has been requiring additional information, right? So information about things like collateral, margin data, UPIs and UTIs and so on. So there's more time to assemble and validate a richer data set, right? And I think that's really the key thing to remember. Um, the focus shouldn't be on speed so much as it should be on accuracy. So, sure, there's a trade off. You don't have to get it in 15 minutes, but I would say that there's an added requirement to get it right.
So we're really optimizing now for high quality reports, and every extra minute you get to do it means it better be of even better quality.
That's right. Yeah.
And I mean, sticking on that topic, now we have this reconciliation requirement, which I assume is also there to drive that quality. Era, I must admit, I was a little confused on this one. So, like, this makes sense to me in other jurisdictions where you've got dual-sided reporting, both sides on, alleging the same trade, and you've got to clean this up afterwards. In Canada, with single-sided reporting, what does this reconciliation process really look like, and what types of reports are market participants expected to reconcile?
Yeah, so that's a great question. And I completely understand the confusion, especially when you're coming from a jurisdiction like EMEA, where the dual sided reporting naturally leads to the inter and intra TR reconciliation between those two reports. But in Canada, under the single sided reporting model, the reconciliation requirement is quite different. You're not reconciling your trade against your counterparty submission. Instead, you're reconciling what was reported to the trade repository against your internal books and records. So you'll hear this called the verification requirement. There's really two key objectives to this process, which is the accuracy. So confirming that what was reported reflects the correct economic terms and life cycle events of the trade, and the completeness, making sure you haven't over or underreported. Now the obligation to perform formal schedule verification reports is sort of different based off your reporting designation. So, um, you know, notional amount threshold dealers must conduct this formal review at least once per calendar quarter, where clearing agencies and other dealers must do this every 30 days. But for non dealers, you don't have this specific burden, though you're still expected to ensure your reports are correct. You're just not subject to the formal verification timelines. What's not required, but is worth consideration is alleged trade reconciliation. That is checking for trades that your counterparty may have reported that you expected, or vice versa. And since Canada doesn't require both sides to report, it's entirely possible for trades to fall through the cracks and both parties assume that the other party's handling it. And without some sort of form of alleged reconciliation, those gaps can go undetected by both counterparties and the regulators. Um, so while the Canadian reconciliation focuses on internal accuracy, you may want to consider going one step further to sort of just verify all of your trades actually were reported.
How would a market participant do that? Like, let's say you're an MSB dealing with your bank, and you're assuming your bank's reporting. How can they go about double checking?
So most of the TRs offer alleged trade reports. So you could go and pull trades that were alleged to you that you did not report, but you were a counterparty of, and basically take that combined with your open swaps reports from the TR to sort of do that sort of full reconciliation. The one gap that can be difficult is that those trades, of course, can be reported to multiple TRs. To really see the full picture, you may have to connect multiple, or you just say, okay, well, at least I'm doing it to, one or two.
Yep. So we're talking a lot here about asking market participants to spend a lot of time on their reporting, on their data quality, on their reconciliation. The question I get asked all the time is, it's been 10 years. No one's got in trouble for not doing this properly. But at the same time, I'm hearing from customers and colleagues in Europe and Asia that enforcement has begun since the rewrite. And I guess my real question here, let's start with you, Noah, is are you expecting to see an increase in enforcement actions in Canada?
Yeah, it's inevitable, right? I mean, we know that there will be. I think you're right. There haven't been a lot of enforcement actions so far, and I wonder if in Canada that creates, perhaps that is, and I don't mean this in a critical way, but are participants maybe getting a little complacent. But if we look outside of Canada, we've certainly seen a trend of increasing enforcement. There has been enforcement in Europe, as you mentioned. There was some enforcement in the United States. There was one in Australia that was announced very recently. Um, you know, that we're seeing in the United States and in Europe, more detailed data quality reviews, inquiries, follow-ups. Look, the CSA has invested heavily in this, right? There's been a lot of time and attention that has been put into this. Uh, and, there cannot not be any enforcement. I think it'll be measured. I think it'll be calibrated. I think there will be opportunities for people to indicate directionally that they're moving and that they're doing the right things. But that only will go on for so long, right? There's only a number of times where you can sort of consistently get things wrong or demonstrate that you don't have a robust system of controls to ensure that you're capturing this information properly. I mean, at the end of the day, if this information is consistently not being well reported, it means that regulators don't have the tools that they need to, protect capital markets and ensure that we have a functioning financial system. So, there's a shared interest in ensuring that this stuff is being done properly. What we're seeing in other jurisdictions are email letters to CCOs, to CEOs, right? Hey, data quality is not consistent. It's not where we'd like to see it. Opportunity to improve. There's the new error materiality test that the CSA is using that gives staff the toolkit to be able to scrutinize the quality. And what I would expect would be themed reviews starting 6 to 12 months, right? That start to target probably the large players at first, because that is where the most systemic risk is, and those are usually the players we expect to have the best systems. And in time, it'll trickle down. And I think that in general, regulators, I think, like to have a few examples, case studies, right, to set the tone in the market, and as a result, after that, things should normally settle down as long as everyone is doing what they're required to be doing. But there will be some enforcement.
And on that note, another new feature of the rewrite, I would say, is the requirement to self-disclose any lapse in reporting. And Tara, I'd love to get your thoughts on the question that I posed to Noah, as well as that.
And so, I mean, like you said, North America definitely saw the longest sort of period of no major reg changes. Now, while I can't predict the future, I would expect that we may not see, massive changes like we saw in this last one, but, hopefully narrower scope, like even if it's just tech spec changes continually, really with the goal to constantly be updating, but getting it to better data quality as we learn, because, as soon as this is implemented, I mean, there's already things I think that are out there that need to already be fixed in the tech spec that is, I think the regulators agree on, the TRs agree on, the industry agrees on. So, there's places that just need to be cleaned up. And hopefully that sort of continues over time, and we just keep working on getting better validations and better data quality. And with the introduction of, sort of those errors and omissions forms and reports, this is definitely a major change to this rewrite, but it does follow step with what other jurisdictions do have in place. So it's very essential that firms become familiar with both the form's content, how you submit it, because different jurisdictions are going to be different submissions, whether it's online or via email. And then you have to figure out how to, calculate those materiality thresholds that would trigger one of those disclosures. And a lot of this information can be found in CSA's published FAQs on this. So I would suggest any reporting firms to definitely go read that and familiarize yourself with it, create policies around it, identify who should be responsible, but of course, the best approach to this is to be preventative. Firms should really prioritize high quality reporting at the onset, supported by effective controls to monitor rejections and timeliness and accuracy. And maybe where those capabilities don't exist, you might want to look into third party services or evaluate even your trade repository themselves, figuring out what the best option looks like, to figure out where those might be integrated tools or reports or anything to sort of help you reduce the likelihood of having to submit those error emissions reports, or to help you identify when you need to submit those reports.
Tara, one thing just to confirm with you. So yeah, you run a TR, and part of what you do is take in the trades and all these reports, valuations, and collateral, and you distribute it to all the securities commissions. In the event that you're filing an errors and emissions report, is this something that the TR facilitates, or should market participants go straight to the appropriate securities commission?
Yeah, so the market participants will need to go straight to the, applicable commission as they identify these, but hopefully you should be able to leverage your TR to identify, what are my rejections, what are the open ones, what are some reports I can identify timeliness, and different TRs, of course, offer different reports around those. So just sort of evaluate that and then see, if it's not there, what do I need to build internally to be tracking these items.
It's great to file those reports. It's better to not file the reports, right? I mean, it's not need to file the reports, right? Because regulators are going to use that as a source of gauging risk, right? And if you're consistently filing reports, obviously it depends on proportionality and volume and everything else. But like if you're consistently disproportionately filing reports, let's just say, it's going to raise your risk level. And then,
so
yeah.
what would be What would be your advice if it comes time to filing these reports? How do you see Canadian regulators respond to them?
Well, I mean, I think they're going to use them as a source of data, right? I mean, I think filing the report is better than not filing the report. And again, like if you're a high volume organization, you're going to file a lot of reports, right? I don't think it's a question of whether you're filing them or not. I mean, I was a little glib before, right? In all seriousness, it's about the volume of reports, the types of reports, right? Are they consistent errors that are recurring? And I think at a certain point, a regulator might say, well, hey, we have concerns about your system or your internal controls or your staff or your external service providers or whatever it may be, right? And you need to figure out, you need to tell us how you're going to fix that, right? Because otherwise, if we're still talking to you in 18 months, then it is going to be an enforcement action.
And I got to ask because I have not looked into this. Is the standards for materiality the same across the provinces, or is it different kind of province by province what they would expect to be reported?
That's a great question. Tara, correct me if I'm wrong, but I think it's consistent across the provinces.
Yes, the form and everything is consistent. It's just that OSC has an online module, others have emails, and there's some different ways you can do it. But in general, you need to calculate, and you need to be calculating those thresholds by province, not just general over the CSA.
Yeah. The other thing about enforcement, and this is a little more subjective, I guess, right? But the different commissions do have different cultures and approaches to enforcement, right? And they also have different histories and different there are differences, right? So we may see some differences that are a little softer in terms of how the enforcement is applied.
I think that's great insight. Tara, you've touched a bit on like the changes and what you expect to come down the road. One of the ones that we've had our eye on is the ISO 2022. Future changes. It sounds like the CFTC is going to do that at some point, and then we're going to have to. Could you shed some light on how you see that going?
Yeah, so for this current Canadian rewrite, the ISO XML is out of scope. In general, we do expect them to come after the CFTC's implementation timeline. Though at this point, it's sort of unclear where that CFTC implementation stands. Originally we had expected an updated tech spec from the CFTC at the end of last year to add some of these CDE fields and then get us to the commodities UPI, which would then be followed by ISO XML. But with the regime changes, that's sort of all been pushed. So we're a little bit of a holding pattern now to see where that goes. So we'll see once the CTC resumes some of these items to get better clarity of what those timelines may look like. So at this point, it should definitely stay on your radar, but it's not an immediate action item.
Interesting. And I mean, continuing with the theme of future changes, just because it does feel like there's going to be a lot coming, and everyone should be aware. You get to chat, Tara, with a lot of the regulators globally, not just in Canada and the US. How confident are we in this rewrite? I always joke about what's the next rewrite going to be called, but how confident are we in this rewrite? Are there any whispers kind of across the regulators across the G20 or what's coming next?
Yeah, so I mean, Canada is definitely aligning with many of its peer jurisdictions that have implemented some of these CDE fields and other things with this rewrite. It sort of reflects, just a maturing regulatory framework across the globe that prioritizes the data standardization and improved validations. But even with that said, a global standard sounds great in theory, but there are some practical challenges to consider. The more you coordinate the frameworks, it can significantly slow down the pace of change, which makes it difficult to implement necessary updates in a timely manner. And, sometimes even though in general it sounds bad to have a change, sometimes what's currently in place is worse than a change to make the process better. So it can also, reduce the flexibility, such as limiting a trade repository's ability to include additional fields that clients might rely on to map to their internal systems or to track regulatory compliance and produce, additional operational oversights for you. Many of these custom fields can capture critical data elements, but those may be missed by the regulators and their tech spec. So when you move to the ISO standard, how to keep those in there and get that push, it can be difficult for sure. Even just things like fields that the TRs need for access get left off. Like you'll see, like right now, I believe it's the UK and others are looking to add agent fields, which, yes, has been left off many tech specs, but it's super critical that the right people have the access to the data because they may be reporting it on behalf of people. So, and there's not always all of the fields you need to track now with the complexities of how many parties do become involved in the trade reporting process and need access to that correct data. And you don't want the incorrect people to have access to that data. So without those fields, that's a big item to continually look at. But as for the next steps, there's increasing alignment around core reporting frameworks, but we have seen continued divergence in some of the implementation details. So sort of the balancing of the harmonization goals and operational practicality to meet those local obligations. It's also important to acknowledge that ISO XML comes with significant cost and complexity to firms. Developing and maintaining that infrastructure to generate and parse the ISO formatted message isn't trivial. For many market participants, especially those non-dealers, it might not be practical or cost efficient for them to implement this. So they may want to look at outsourcing to third-party vendors. Really, it's just when you get to that point, what is your core competency and, weighing the cost benefit analysis of looking at a service provider versus internal builds as these, regs keep changing.
Has anyone globally got close to the ISO standard?
Well, so other regimes like ASIC and Moz just implemented theirs, in EMIR, they have theirs. But even then, there's a continual, an ISO group working on updating those specs. And those specs really aren't consistent. They're still jurisdiction specific specs. So there's some consistent across, but even then, there's not complete harmonization. And when there is a deficiency found, it isn't a quick process to improve those.
Interesting. So even when we find the problems, there's a lot of working groups it's got to go through to actually get it
Yes,
fixed.
a lot of hurdles.
Noah, you touched on this earlier. I'm interested to dive a little deeper. Obviously, a lot of MSBs in Canada, broker dealers are looking at getting involved in the crypto space. How do these requirements apply in the crypto space?
Yeah, it's It's a great question. I mean, to some extent, it's still a bit of an open question, right? It's not necessarily an answered one. Um, crypto is to the extent there's an OTC derivative on crypto, it's subject to the same requirements, right? There's really no difference. Um, the ability to offer crypto derivatives in Canada is pretty limited, right? It can be done at least in theory through with sophisticated parties, but it's certainly not something that can be offered to the general public. There's no framework within Ciro, for example, at this point to offer it even on the basis of an exemption. And based on some recent conversations I've had, it's being worked on, but there's still a lot of problems to a lot of things to solve before it can be before it can get there. However, if you sleuth around, there are some publications where it has been referenced, at least in a placeholder kind of way. So I think it's coming, and I think people should just expect that the same obligations will apply, right? I mean, it's to the extent you have a derivative on a crypto asset, it's really no different than any other. And I don't see any reason why people who are engaging in forward planning towards that should not take this into account. I would recommend they absolutely take this into account and they begin to prepare, speak to Coultra, speak to Core, speak to Renault, and we can all help them, be prepared for that inevitability.
So if you're trading crypto, if you're trading spot, you're probably fine. But if you're trading rolling spot, if you're trading CFDs, if you're trading anything settling beyond T+2, you're still in a gray
Well,
area.
if you're trading that in Canada, give me a call. I want to talk to you anyway.
That is
But
fair.
let's just say it's only being done, in very limited ways right now. But actually, look, to the extent that it is being done, and it is being done on an OTC basis, then in my view, it's subject to the reporting requirements.
That makes sense. Cool. Thank you, guys. We have 5 minutes left. For everyone listening in, if you want to post any questions, there's a chat button on the right side of your screen. Just stick a question there, and I'll ask Noah and Tara. While you guys are doing that, I'd love to just kind of go around the room and just talk. Obviously, everyone on this call is a provider who's helping in some way market participants to meet their obligations. Let's start with Noah. Noah, I'd love for you to share more about Renault and Co. and how you work with clients.
Sure. We take a very practical approach to working with clients. Compliance is not a box ticking exercise. It's a process of, for us, of really challenging our clients to ensure that we understand their business model and they understand their business model. In my experience, it's quite rare for regulatory violations to not be done in good faith. I think most people get up in the morning and they try to do the right thing, but nevertheless, they sometimes don't. And so often a lot of what we do, especially with entities that are in new or emerging spaces or those that are changing, and there's a lot of change happening right now. It's really about challenging them on their business model, getting into it, and understanding what the implications are. For example, we've worked with a lot of MSPs who didn't realize that their FX scheduling agreements were actually forwards, right? Or we've worked with Ciro dealers to understand what kind of licensing they actually need and not what they thought they needed. And we helped multiple firms, self-report and manage problems after the fact. And so we build our regulatory map from the client's business model. And we don't just flag risks. We say, here's what you can do, here's what you can't do, and here's how we're going to help you do it. That's why our
Very
clients come to us, and we try to make compliance a competitive advantage.
And in my experience, the firm is incredibly knowledgeable, one of the best on the street. Tara, I'm going to guide you a little bit more here in my questions. Firstly, obviously, Core is a new TR. I don't think most people I speak to have actually heard about Core. Now Canada has 4 trade repositories. Can you maybe share why Core is different and what brought Core to Canada?
Yeah, so the existing trade repositories, ICE, CME, DTCC, they were originally built at the start of reporting, probably back in 2010, 2011 is when they started building. At that time, the direction and complexity of global derivatives reporting was still largely unknown. And those infrastructures were designed under immense time pressure and limited foresight into regulatory expectations and the evolution. So really at core, we had the unique opportunity to take a step back and reapproach trade reporting with the benefit of high insight. Our team is composed of former senior employees of all of the other TRs. We sort of understood the limitations of those earlier build, and we founded Core because we believed we could really make something better, and that the market was underserved, and that there's really an opportunity to have a more modern client-focused TR. And rather than doing just sort of the bare minimum to satisfy our own regulatory obligations as a TR, we've prioritized features that help our clients meet their obligations, through more insightful reporting or dashboards and just support. In short, we've just built Core to be more compliant, but, to be better.
Yeah, I mean, I've worked with, I think, all of the repositories at this point, and I found the core team to be very knowledgeable. And I guess that takes me to my next question for you, Tara. Most of the TRs just offer TR, and then market participants have to figure out how to do the reporting. In Core's case, you also offer a reporting service module that helps you report not only to Core, but also to other repositories as well. Why did Core take that route?
Yeah, so Core offers a standalone reporting services platform. It's really designed to support the submission to multiple TRs, not just Core. We built this solution because most firms, trade reporting isn't a revenue generating or core competency, but it still is a mission critical system to stay compliant and avoid regulatory penalties. In practice, we've seen a lot of times, IT can become a bottleneck for firms that need to implement regulatory changes or expand their reporting coverage if they want to enter new asset classes or new products. And oftentimes, developers are asked to translate very complex compliance and business requirements into code, often without the full visibility of how that logic evolves or how regulatory guidance may shift over time for that. This often results in these black box solutions that compliance and operation teams struggle to validate and adapt over time. Core's reporting service, addresses that directly. We built a system where compliance and operations teams can really see in plain language how their data is being transformed from their internal systems to into that sort of final regulatory submission. The platform supports critical infrastructure like package management, UTI management, API identification, reconciliation functions, and multi-jurisdictional reporting, including delegated workflows. Firms are able to just submit a single message and have it routed to whichever repositories, real time or transaction reporting, and that can go to Core, any other TR. Our systems give operations teams a controlled flexibility to make those configuration updates, add mappings, reprocess data, all without really having to go back to their IT teams. It's very purpose built to reduce the friction and increase transparency in our regulatory space.
It's very interesting because as a tech company, Culture obviously has the resources to write the code, and we have been reporting ourselves for the last 10 years, plugged into various trade repositories. And we eventually hit the point with these rewrites that too much is changing too quickly. It's too complex. Our customers rely on us too much to figure this out. And we actually realized we had to bring in some outside help. So we haven't actually announced it yet. I guess this is the first of it, but we've actually partnered with Core to build a full end-to-end solution. Obviously, on the one side, you've got to get all of the data over to the trade repository, and Core is helping you to make sure the data maps in correctly into the trade repository. Culture is providing a very simple interface for customers to be able to submit their derivative transactions in a way that's familiar to them. You're booking a forward, an NDF, a swap, or an option. We've then mapped that directly into Core reporting services, where Core will enhance that data. We'll then provide them lifecycle events. We'll provide the collateral, the daily collateral reporting, and then Core will map that to the correct trade repository. If you work with Core, obviously we can handle that. If you work with DTCC, we can handle that as well. So we're really excited to be working with Core on this. We expect there will be a lot of changes moving forward. I think that was a theme on this call. And we're very happy to be in Core's trustworthy hands so that they can keep us up to date and all our clients reporting correctly. This brings us to the end of our webinar. Thank you to everyone for joining. We hope to see you soon. Have a wonderful day.
Thanks.